Welcome to Timeless Building and Business Strategies. This is Tony Johnson. I'm here today with Jeffrey Rosenberg from Big V Properties. Jeffrey, thank you so much for joining us.
Happy to be here, Tony.
So, Jeffrey, could you first give everyone a background on you and how you got into real estate and development?
Sure. I'll give you my quick elevator speech. My grandfather started a corner grocery store in 1942. He opened a bigger store in 1952. And funny story, he actually sold 6% savings bonds to all of his customers to raise the capital. So he was actually, I would consider, one of the first crowdsource funded companies out there. And I remember back in I want to say 85, he was telling me it was the last bond to be paid off from the 50s because it was a 30-year. He sold 30-year, $100, 6% savings bonds to all of his customers to raise the capital. But he opened up a second store, and that grew into a fairly large supermarket business. We sold the supermarket company in 1987, kept the real estate. We owned a host of shopping centers plus the supermarkets in them. And then over the years, we have transitioned our assets to the south and southeast and southwest parts of the United States. We are completely vertically integrated. Today, we have about 10 million square feet in about 14 states across the U.S.
Wow, amazing. So, could you tell us how Big V evolved over time to stay ahead of the market and grow?
Well, we started as a supermarket company. We uh, we owned all of the real estate, and so we were always in the real estate business. We sold the supermarket company, and as I mentioned, we transitioned our assets to the south. But as we've grown as a real estate company, we started off in the beginning. I was buying small $2 million, $3 million shopping centers, $5 million shopping centers, mostly strip supermarket anchored. We grew and modified our acquisition targets to a larger format center back in, I would say probably started in 2015, where we started to focus more on the 20 to $30 million open air centers. And then we grew that portfolio and continued to look at higher and better properties. And so at the end of the day, most of our acquisitions were best in class open air, usually Target or Walmart anchored centers in the best part of the retail market within a high growth demographic market. And so our acquisitions range from, a $50 million center we've purchased up to $200 million.
So that is a ton of growth. And I know we've spoken briefly prior to this, and before, you were at the $2 to $3 million mark, and now you're at the 50 to 200. And what you stated, which I think is profound, and when anyone's trying to scale that much, you really have to set up systems and processes to be able to get to that level and not be falling apart, chasing your tail, and be completely unorganized and have some things collapse upon you. Could you walk everyone through how you set up everything prior to getting to that level and to make it a smoother transition for growth?
Sure. So when we were really small, we actually decided to invest in a much bigger system. So there are two basic systems in the industry today for managing our types of products. There's MRI and Yardi. And so we chose Yardi as our base, but we chose their biggest system. So we did not use the Yardi starting system or whatever. We chose the biggest Yardi system that was out there because I always knew that we needed room to grow. Because every time we add a shopping center to our portfolio, there is no impact to our operations. And so when you think about the complexity of that, right? Onboarding, new tenants, accounts payable, accounts receivable, there is no organizational impact to the addition of additional square footage because of the systems that we have in place. we've also invested heavily in Salesforce. And some people like Salesforce, some people don't, but we've developed our own Salesforce applications over the last 10 years that really helps to manage our entire leasing process and it manages our legal process and manages the entire system and is fully convergent with Yardi. So we have it set up so it communicates back and forth with Yardi as so that we are as efficient as possible in managing our business. And as you know, in the retail side, it's a very detail oriented business. And when we're doing a build out and you're in construction, so you've got timelines, you've got various trigger dates. If you have to approve a plan within 10 days, if you don't approve the plan, then it's automatically deemed approved. And if so those whole trigger dates, which can potentially really screw you up if you miss something. And so we built an entire Salesforce system that manages that whole process so we don't miss trigger dates. And then I don't know, we do about 50 million in construction on a yearly basis. And that's, new pads, new buildings. We're under construction now for a new Target in Wilmington, North Carolina, in your neighborhood.
Yes, sir.
And so that's all tied into our systems and processes as well.
And it's really interesting because there are so many that go through this process, and to get to your level is extremely difficult. So, a lot of people can start getting into development, but when you try and vertically integrate, this becomes not just a little real estate firm where you have a couple people, you can get some VA assistance. You're running a full operation once you vertically integrate. And so when we're talking these big deals that you're putting together, when you transitioned out from the grocered anchors to the retail, what was the biggest difference you saw in operational and the ability for growth?
Well, so a couple of comments. Number one, the grocery business is very, very low margins. And so when we were in the grocery business, you have to operate super efficiently in order to make money. And it's similar in our business. In construction, one little miss and we could be off $100,000. And so you have to be really efficient from an operations basis in order to make sure you don't miss anything, that you're delivering what you've promised to deliver to your customers. I mean, it's probably similar to your construction business as well, where you need to be customer centric. Our customers are our tenants, our investors, our constituents. We've got entitlement issues, right? So we all have entitlement issues on development, and whether that's dealing with the municipalities, with the DOTs, those are really important components that you have to manage efficiently. And so we've got a whole group of people that continuously manage that process. We're doing, subdivisions on development, and we're doing subdivisions on out parcels, and we're always in various municipalities. And so those pieces and the efficiency in which you're able to handle them help to fuel your growth, because the market rewards people who perform and do what they say they're going to do. And so everybody says, "Oh, I could have done that. I could do that." But
Mhm.
that at the end of the day, it's those people who do what they say they're going to do, and continuously do that over a long period of time, are those people who actually, do the new buildings, who get awarded the contracts, who are able to grow their business.
Absolutely. Yeah. This is a marathon, and reputation is everything. So
Yep.
when you're dealing with these large retailers, it's all about performing on what you say you're going to do over and over and over again. And so I have a quick question. When you're going through this, one of the biggest challenges on timelines is getting through that entitlement when you're going to these different areas, dealing with different municipalities, and you have DOT to deal with. There's constant different challenges that you run up with. Do you guys have your own design team that works on your civil, or do you always farm that out, or do you in-house civil design work and in order to move entitlement through faster?
No, we farm it out. So we have a group of partners that we use on a consistent basis that we've dealt with for many years. We also sometimes use a local expediter, which, may be a little bit more costly, but certainly efficient in terms of getting things done. I mean, a lot of times we've got tenants who are doing their build outs, and the tenants, need really help from us because they're either sometimes they're mom and pops and they're building out a new store. Sometimes they're nationals and but they're franchised and the franchisee needs help. And so everybody's goal is to get a tenant up, built, and operating and paying rent as fast as possible. And so
Hmm.
if we can shorten that time, and we track the time, so we track from the time a tenant calls us to when we sign the lease to when we start and deliver their space to when they get open and when they start paying rent. And we use that as one of our KPI metrics is to look at squeezing those time frames down because every week saved that where we can deliver quicker is a week faster we receive rent, and it's a better outcome for us and for our investor group.
Absolutely. And so to speak to that, for people who aren't so familiar, when you're going through and when we're talking through this, so when he's going through entitlement, building the shell, he's getting a lease tenant, though let's say it's a national franchise, the tenant, the franchisee, he may have never opened one of these franchises before. So Jeff's having to walk them through the whole process of opening this, and you're trying to get all of this done. And you're at an advantage because when you're doing the shell, you can get a portion of that upfit going,
Right.
and you already have the trades there. So you're more cost efficient. So you have an advantage when you're doing that, which is a great reason to vertically integrate the construction to your development. But so, yes, to speak to all this, every single week makes a difference to you to get that rent earlier because, the client probably based on the lease agreement doesn't have to pay rent till you get a CO and they're ready to occupy. So all these things, in order for you to make money, you can really make a lot more money or really lose a lot of money based on just a couple months turns into quite a bit of money when you're dealing with this amount.
Yeah. Yeah. And actually what's also kind of interesting to remember in the real estate business, the landlord is often looked at like a bank, right? And so you know that the landlord provides certain we call it tenant
Tenant
improvement
improvements.
dollars, right? Where we'll, provide X dollars. And so typically a tenant may be spending our money. And so our goal is to make sure that they're open faster because it's our money that we're giving them to improve the space, but we don't start getting a return on our money until they start paying rent.
Right, absolutely. And a lot of these, they'll want an agreement where they are not paying rent for a few months, even after they get in the space. So not only are the tenants asking you to front them money with the tenant improvement allowance, then they'll want, 3 or 4 months rent. So these things can really put you in a pinch if you don't hit that timeline. And yeah, you're really invested in. And, the shocking thing is some of the people that don't have a lot of experience, that don't have, multiple locations already, they think the tenant improvement allowance is supposed to cover, half their build or something, and then they want the money for free. They don't quite understand the amount of risk and overhead you're putting in because when you put in those short term tenants, if they don't survive the 5 or 7 year lease agreement, they go out, they fall out. You have to re-tenant that space. The new tenant doesn't want that build out. They're wanting TI again. So
That's right. That's right. And we own several of our own office buildings where we have an office building in Charlotte, an office building in the state of New York, and then some additional office buildings. And the office market, surprisingly, is even worse, right? Where I don't know if you know much about building in
yeah,
the office building market, but Holy mackerel, you could spend every office tenant wants a complete build out from scratch, and everybody's different. And you do this build out and someone leaves in 2 years, and you've spent money where you're going to only recoup it over a 5 year period, and now you're 2 years in and you lose the balance of your investment, and you have to reinvest to for another office tenant. And so retail is similar to that, not as bad, but retail is similar where you're right. If a tenant goes out of business, we have that now. We have a tenant that we paid a TI package to. They can't afford for us to pay them, and they pay the contractor. So we actually had the contract assigned to us, and we pay the contract directly. There are those scenarios as well.
Mhm. Yeah,
Um,
that happens quite a bit actually with any of the newer, franchisees or just mom and pops. They run into that quite a bit. So, you know, that is something you need to do your due diligence whenever you are leasing out space to the mom and pops to make sure they're financially able to cover what they're signing on the line for. It's easy for someone who doesn't have a ton of money to go sign these things. So you really have to do your due diligence, even if you're trying to fill a space. Slow to approve anyone in the space because, like we're talking about, someone like you guys, you could really put yourself in a pinch if you have two or three of those tenants fall apart. That turns into quite a bit of money, especially if we're talking about a 20,000 square foot space. This is no small thing when it
right.
falls apart, right?
Right. Yeah. And that's part of our build out in Salesforce. So when someone comes in, they get a lease, the leasing company then pushes it through Salesforce to credit. Credit will run background checks, and credit come back with an approval or a denial, or say something like you need another guarantor, or you need, X, and then they'll go back, be pushed back to the leasing individual, and they'll say, all right, we can't approve you with your credit. And they don't see credit scores. So our leasing folks, I mean, it's only through our credit department that they see credit scores. But the leasing team and the team who are asking for credit checks will get a red or a yellow or a green, or a green with a personal guarantee, or agreeing with no guarantee, or those types of things. And really, really important to understand the risk that you're taking when we as bankers, we're
Right.
landlords, but we're bankers, provide capital to our tenants.
Right. And so let's, on the reverse side of that, we could go to someone like, when you mentioned Target, some of these bigger retailers. So it's a flip difference on that incorporates your risk as well, because for them, they want much lower rent. They want you to get their space to a certain portion. They don't want a TI. They want the space built out to a certain extent, then turned over to them, and they just have their portions come in. Right. So could you
Yeah.
speak to that to if someone understand that's a whole different ball game. So with the bigger retailers.
Yeah. So, for example, we're under construction for a Target project in Monkey Junction, right near you guys in Wilmington, North Carolina. And Target bought their land from us. They don't want us to build their building, though. They're building their own building, but they want us to create the site, put the parking lot in, parking lot lights, put all the access in, do the off sites, which we're doing that. And then once we complete, and I think it's going to be done very shortly, then we turn it over to them, and they'll start building their store. And they don't want us to build their store because their cost of capital is a lot less than ours. I mean,
Right.
you think about it, we're borrowing money at what everybody else is borrowing money, 6%, 7%, whatever it is today, 7.5%. But Target's borrowing money at 4, 3.5, whatever their corporate internal rate charges. And so they can borrow money a lot less than we can. And so they're all building their own stores. And a lot of times we do a lot of pad sites. We do a lot of ground rents where the tenant just wants us to say, here's your piece of dirt. It's got sewer, water, electric to a specific place you've designated. We've finished all the parking and the easements are in place. Now, tenant just spends their own dollars. A national tenant usually spends their own dollars and just builds their space. We're doing that with in Houston, Texas, is a shopping center we own. We're putting in a Twin Peaks to replace a TGI Fridays, and it's the same thing. It's a ground rent. They're taking the TGI Fridays building. They're going to I don't know if they're going to take it down or redo it, but from our point of view, we just have a ground lease.
Mhm. So for those that don't understand, ground lease, could you go through that, Jeffrey, just so someone understands the difference in you guys doing a ground lease versus selling the out parcel?
Sure. So when we do a ground lease, we basically sign a lease, a long-term lease, and usually it's 20 plus years with a national tenant who then builds and owns their own building. So we own the ground underneath it. They build the building. At the end of the lease term, the building belongs to us, right? But their cost of capital is much less, and we would charge them a lot more rent for us to build the building. So right now, our rent is based upon the cost of that dirt. So if it's $1 million that we assume on the market piece of dirt, we may charge $100,000 a year, right, for that $1 million or some, return metrics that we're looking for and not build a building. And for us, we like ground leases. I mean, they're easy to handle. You don't have to worry about building issues, and there are access agreements related to those that, the tenant still has all the access to parking and driveways and whatever. And if we had sold that piece to the tenant instead, we would then not get the benefit of a long-term tenant as part of the shopping center. And when someone owns their own piece, they can do whatever they want with it. And a lot of times we want to make sure we understand what the use of that out space is going to be, right? And
Mhm.
so because if we sell I don't know, like the TGI Fridays, if that was a TGI Fridays and we sold that to TGI Fridays and they're in bankruptcy or they close the store, we can't control what actually goes there,
Right.
right? TGI Fridays could put I don't know, anything that they want there, but if we own and have a ground lease, we can control what actually ends up replacing TGI Fridays.
Right, because this could ruin you having a full center behind you. You have these out parcels in front. You get somebody to go in there and does some piece of junk or like a garden center where you've got something that doesn't make any sense
Yeah,
that
right,
matches up. It will deter traffic into the center. And so
right,
this is a smart maneuver to hold on to make sure that because not only does that out parcel, you want to keep that filled, but when you start getting different types of tenants, then your major retailers behind you might say, well, we're getting terrible traffic through here, so now we don't want
right,
to renew. So it
right.
could spoil the whole entire master site. So
Right.
that's
But I will tell you that there are some out parcels that we do sell. So we own some Chick-fil-A's. We sold those. We own, some uses that we don't think will change over a very long period of time. And if we can build a Chick-fil-A for $1 million and sell it for 1.5 million, maybe then we know the use won't change. That could be a benefit. If we like a bank. So currently we're under construction with a Wells Bank,
mhm.
and we have that in the market to be sold. And so we build it to a certain cap rate, right, or cost, and we understand that we're probably going to sell it at a different cost and give us a little bit of a nice profit. Now, some of the retailers really, as you mentioned earlier, a lot of the retailers control the amount of profit you can make. And so
Right.
they're really controlling in terms of your ability to make money. And many of the supermarkets, if you're building new supermarkets, many of the supermarket companies control your profit.
Mhm.
Many of the major retailers for new development control your profit. And so it used to be, 15, 20 years ago that it was more profitable than it is today.
Yeah, especially right now with the inflation, because those retailers, they don't want to go up on the amount that they're spending. So there's a crunch there. The land price is up, so they don't. you get your profit a lot of times from getting a great land price, but the land prices are up, right? So
Right.
that's crunched you. Then the construction numbers up. Let's say it's up 20%. The retailer might go up 10%, right? So there's a variation there in how much more. And they're saying, yes, well, this is the max we're going to pay for you to get this site to this point, or
Right.
get the site and the shell built and hand it over to us. And this is the set we're paying. So then, to your point, you have to figure that all up. And that really, you have investors that just want to go and buy that because, you'll walk into a 20-year lease. And so they just, at a cap rate, want to buy that cash flow. So there's a lot of pressure on you to go in there and build it at the number. And you don't know if you have unforeseens that come up underground. Those things don't matter to them. That's your
Right.
problem. So you're going in at a tight margin. All of a sudden, you could really lose your tail. So it takes a lot of courage to do what you're doing, Jeffrey. And so that's amazing. Now, if people, do you let's say you had a developer that wants you to go find him some land and build him. Do you ever do that, or is everything just for your company only?
We do that on a very limited basis. And so that's not a big part of our business. But, sometimes we can't even, so sometimes we own property where we want to develop, but because of our cost of capital, it doesn't make sense for us. And so we actually sell it to a national, Hardee's developer, or a national, Chick-fil-A developer, if there is one, or a national McDonald's developer, right? And so because they can build it if they have a relationship with McDonald's, or a relationship with Hardee's, or a relationship, and they have the plants, and they have the exact costs related,
Yep.
and they can do it cheaper, more consistently than we can. And for us to make in a $2 million investment, for us to make $100,000 is very, it's not
Not
a
very appealing.
no, not very, because the risk is we don't know that business well enough, and we just made $100,000 mistake. And
Right. Yeah.
whereas a national developer for one of those
Quick
quick serve
service
restaurants,
restaurants. Yeah.
they do it day in and day out.
Day in and day out. And I will tell you, they have those things so tight. There is not more than 100,000 on a 2 million build out. I can tell you that. So yeah, you are
Oh,
high
really?
risk. Yeah.
Is that stand? Because that's
Yeah.
what we were looking at. I'm like, I passed on it. I'm like, listen, we own the dirt. Well, I'd rather sell the dirt to someone who's who does that day in and day out. We don't do this day in day out. Like we don't build 50 of these a year. We don't build 20 of them. We
Right.
build two, right?
Mhm.
I'd rather let someone who builds 50 of these a year do it. And
Much
you know,
smarter. Yeah, it's a niche. It's the
yeah.
Starbucks, the Hardee's, the McDonald's, even the Chick-fil-A's, all of them, the Freddy frozen custards. A lot of these that are really growing and expanding right now. It is extremely difficult with the way numbers have moved right now. And as I was speaking to earlier, these people, they don't want to go up on their number. So
No.
there is these things have tightened up so much. So the labor that you have to get is inadequate to perform the work that's needed on these spaces. So you really get yourself in a bind because you've got to hit timelines and dates. And then you
Yeah.
have, in order to make the numbers work, you have to use inadequate subcontractors and labor forces to hit your number that can't hit the timelines.
Right.
Don't have the crews to perform the work as promised. So yeah, you're smart to not get into that. And so anybody looking to get into those things, be very cautious. We don't want you to get injured. So Jeffrey, thank you so much for joining us today. We'd love to get you back on, talk some more, and I appreciate your time today. If someone wants to reach out to you directly, what's the best way to get in touch with you?
They can reach me by email at jrosenberg at bigv.com. They can go to our website, bigv.com, and I think all our various contact information is there as well. And if you'd like to learn more about, what we do in terms of our development program, our construction, as I mentioned earlier, we do about 50 million a year in construction projects, which is, fairly decent. It's not big, but it's not small. And so we are always looking for ways to improve.
Absolutely. And so also if you have some good land opportunities that you'd want to share with Jeffrey, Jeffrey, where all do you invest?
All across the South. So Southeast, Southwest. We own assets from the East Coast all the way across to Arizona. And so we're looking to continue to invest in the southern part of the US.
Absolutely. And mainly just retail, correct, Jeffrey?
Yeah, we own some, like I own a couple of office buildings. I own some multifamily, I own some single family, but right now our focus is really uh, open air retail centers.
Fantastic. Well, it's been a pleasure having you on. It's a lot of great information for anybody that's, interested in retail development and growing their business in that route. So, Jeffrey, thank you so much for joining us, sir. I really
All
appreciate it.
right, will do.
Have a great day,
Okay,
sir.
you too. Bye now.
Bye bye.